Hello and welcome. Today we'll have a look at a company which has disappointed investors in the last 1 year, but seems like you're at the edge of a turnaround with regard to MapMyIndia. When you're looking at the 12-month stock chart, you'll likely see indications of that. Over the last 12 months, we've seen some pressure because execution lagged, especially in FY26, and you can see that. But now, the rebound in the stock price has been healthy. We're currently sitting at 1,062 levels on MapMyIndia after hitting 800 rupees from 1,900 rupees a share. So you've seen some real sharp moves. And now you're trading at sub 30 times 1 year forward with a possibility of strength, at least in FY27. Q1 numbers also indicated that to some extent. Let's in fact take a bit of a step back, try and understand the company better. This was incorporated in 1995, which is MapMyIndia. And what it has done is it's built an indigenous digital map and provides also geospatial software. It's also into Internet of Things now. But broadly, that's how the business is in terms of the vertical. And it's part of MapMyIndia, and Maples is the brand which they have. It's a digital mapping, auto software and IoT company. It's largely promoter-led with a market cap of around 6,000 odd crore. Now, the larger story, right? In fact, this was one of the very, very early movers in digital maps. And, the story is that in 1995, MapMyIndia actually physically drove down Indian roads and recorded every turn and landmark. And what it built was one of the most detailed digital maps of India, and they built it from scratch, and this is much before Google Maps, right? So that map is the asset. Everything else in terms of service and product is built around the asset itself. And now what it does is it sells access to the map to everyone who needs it. The kind of customers or the cohort of customers that need it, well, car makers, banks, logistics companies, government, and the like, right? Now you've also got quick commerce, and that too is one of the levers. What they do is they build the map obviously once, and then the target was that you monetize it endlessly. So that's really the structure of it. In terms of the pillars of the business currently, even in terms of monetization, one is the main pillar, which is maps. It's the original high margin business. Typically, it surrounds the map itself, which is provided to the customer. Then there's navigation, analytics, and the like. There's, in fact, an entire navigation software they've built for vehicles, phones, as well as indoor venues. You've got a software business as well, which is also something that they have alongside the maps. And it's a high-margin business. It does EBITDA margins of 50% plus, and it's nearly 70% of the revenue contribution. And then there's Internet of Things. Now, this is the newer and the faster growing business. It's lower margins, and its core is not the service, but the product. Thereafter, once you've got the product in the hands of the clients, it's the recurring service revenue, which they try to build on. So it's dual in its form. In terms of the type of products that are there, they've built a GPS system, a device itself for vehicles and fleets, the likes of an Uber and Uber operators. So those entire set of fleets use this one. Then there's dashboard cameras, video telematics, and the like. There's sensors, custom electronics also that they have for mobility as well as infra solutions. You've got device as a service rentals, which they receive for connected vehicles. There's hardware that creates really the hook. That's the model in which they work in. And then there's a subscription software which creates recurring revenue for them. So essentially, these are the two major verticals. In terms of maps, I'll go back to maps, and there are three ways in which they market, sell maps. The business model is on a three-pronged approach. One is maps as a service. This is for customers who pay for access to the map through their APIs. Then there's software as a service, where the software itself is provided to the customer, and the customer pays a subscription fee for the software, which is built on the map itself. And then there's platform as a service, which is customers build their own applications on MapMyIndia's platform. So these are the three broad ways in which they structure their services. The same underlying map is monetized, of course, in 3 different formats and ways. And increasingly, it's the recurring revenue, which MapMyIndia focuses on, and not one-time license fees or the like. It's a recurring revenue kind of model. Now, who buys from MapMyIndia? It's the first and the easiest way, or the easiest cohort of customers is automotive and mobility. That's the cohort where there's in-vehicle navigation, EV routing, there's HD maps for driver assistance and the like. 35 lakh new vehicles have been integrated with this technology in FY26 alone. Customers, well, there's MG, there's Hyundai, all of the other OEMs, all are potential customers of MapMyIndia. Now, the other one is the enterprise and consumer tech. This is for logistics, banking, insurance, manufacturing, to locate addresses, to ensure that you're verifying addresses and of your customers. Essentially, that is what this is used for. And that's not consumer, by the way, that's enterprise and consumer tech. And in enterprise and consumer tech, they geo-verify addresses for banking and financial services as well. Quick commerce and new age tech also uses this particular set of services. Then there's government. And the government uses it for defense, taxation, urban planning, it's basically a platform which the government uses quite actively. Contracts, surveying, which the government does. About 20% of MapMyIndia's revenue comes from the government directly, and therefore the government is a large customer for MapMyIndia. Consumers, that's done through the Maples app. There's navigation, safety, mobility, with over 4 crore downloads on the Maples app. They're continuing to consumerize the data that they have and the app that they have. So that is still a work in progress. Then in terms of geography of revenue, 78% of the revenue comes from India, 22% comes from international. So that's how it's structured. Talking about the revenue metrics on your screen now, you've got a 19% growth CAGR on the business, but remember, between FY25 and FY26, growth has just been low single digit. And despite that, the 3-year CAGR on growth is 19%. So therefore, we'll try to understand whether FY27 meaningfully improves in terms of the growth rate, even versus the 19% they've done 3-year CAGR, because of that lag that you see in the last year of that 3-year period, right? And we'll try and get a better picture of that. They're sitting on a very healthy order book. I'll come to the order book, but let's talk about EBITDA now. And EBITDA, therefore, has been very robust. I did speak about the platform business itself, which is the maps business itself, delivering very high EBITDA margins. But essentially, EBITDA has grown at 13%, and that lag is because of the revenue growth lagging in FY26. Otherwise, you've got very strong EBITDA growth. If you look at FY23 to 25, the EBITDA growth has been over 50%. So you've seen very, very strong growth per se in those 2 years alone. And therefore, brings me to profitability. You've seen just 7% growth on profitability, again depressed in FY26. This is up to FY26, by the way. Q1 FY27 numbers will come on your screen in just a minute. But broadly, this is how the last 3 years have panned out. Again, you'll see the very solid growth between FY23 and 25 in profitability as well, which isn't reflecting in FY26 as a result of what we've just spoken about. Q1 FY27, you've seen 15% growth on the top line, YOY, still shy of the faster clip of growth that we expect. EBITDA has taken a bit of an impact because there's been a write-off which they've taken of approximately 4 crore. If you add that back, of course, EBITDA goes up again to approximately 15%, so largely in line with the top line growth. Profit is around 10%, and that the write-off they've taken is around 80 lakhs. But the write-off, the top line write-off has been 4 crore, and the adjustment that they've made is in other income, which is why it's not reflecting in the EBITDA number, but it's reflecting in the PAT number. And therefore, you'll see the difference between EBITDA and PAT not being large because the other income is inflated as a result of the 3.2 crore recovery on the back of the 4 crore rupees which was due and 80 lakh rupees written off. That's broadly the numbers. Now let's talk about operational metrics. Again, you'll see very strong numbers coming on your screen. You'll see margins north of 40% in most years. FY25-26 was slightly lower, and that's because of the lower volume of business that they did, especially in FY26. The margins will come up for you on your screen. There you go. And Q1 FY27, they've reverted back to 39%. If you adjust for the one-off, it's ahead of 40% in terms of EBITDA margin. So margins have reverted back, which is the key positive. So it's a twin engine which is playing out. Top line growth has come back and margins also kicking through. So let's try and figure out as to whether this can sustain or not. We'll speak with management on that. In terms of the order book stands at 1750 crore at the end of FY26. It's 3.7 times book to bill. No concern with regard to order book growth, which is coming our way. Let's look at the balance sheet now. And the balance sheet has around 900 crore of equity, which is the equity base of the company. It trades at around 7 to 8 times book at this point of time. And by the way, it trades at nearly 11 or 12 times sales. So that's something to highlight as well. But you've got zero borrowing, so no concerns on the balance sheet at all. And you've got a cash bank balance of around 80 odd crore sitting in the balance sheet. In terms of cash flow, you've got a drag in terms of cash flow given government contracts, and therefore receivables and working capital is where this is locked in. You've seen receivables go up quite dramatically. FY26, we'll try and understand whether that's unwinding in FY27 at all. ROC and return ratios, you've seen return ratios constantly trend above 20%. No surprise at all on that. It's a clear thumbs up from that perspective. No problems. When you're looking at shareholding pattern, 50% plus held by the promoters themselves. Good skin in the game. FIs hold around 2%. They've sharply withdrawn from that high of 7%. They're now down to just 2%. DIs have increased their stake consistently in the bargain. 13% is what they hold. Public largely as is at 34 odd percent. Also, you've seen the stock drag, and therefore you've seen some retail participation come off, which is visible for you. In terms of analyst recommendations, 5 buy calls, 1 hold call, 2 sell calls, very mixed. Therefore, we've given this one a neutral, but a 19% upside is what analysts are penciling in on this one. In terms of the valuations, let's quickly pull that one up as well. The 1-year forward price to earnings multiple is 29 times, sub 30 times, 20% growth. If they're able to do, then this could well be an attractive one from a growth to PE perspective. The PEG, which you typically calculate, the 2-year average though is 42 times is what this one is traded at. So it trades at a substantial discount as well. And then you've got a 2-year range, which is roughly 22 to 66 times. That's broadly the 2-year range which the company has operated out of. When you're looking at the growth metrics, 100 crore increase in revenue expected this year as per consensus, and you'll see a consistent 20 to 30% growth on the top line. This is basis consensus. The EBITDA also, you're expecting to see a 38 to 39% EBITDA margin kind of number, which should take the EBITDA growth, absolute growth, to 20 to 25%, and profit as well is likely to compound quite well. As a result of which, your price to earnings ratios will shrink to 26 in FY28 and 21 in FY29 if these numbers are met. The goal is to hit the 1,000 crore number by FY28 was the goal. We'll try and understand whether that can actually be met or not. Not part of the estimates though, just broadly. But what we'll do is slip into a very short break. On the other side, we'll speak with Rohan Verma. He's Joint Managing Director at MapMyIndia, joining us on the other side. Stay with us. Welcome back, and we're analyzing MapMyIndia today, and we have with us Rohan Verma, who's the Joint Managing Director at the company, joining us. Rohan, great having you first off. Thank you. Rohan, I want to first start off by understanding how traction for FY27 looks to be building up, because the base for FY26 is low. Do you play catch up in terms of FY27? Does execution pick up significantly, meaningfully?
Yeah, thanks, Harsh, for having me. You really analyzed the company well. And as you said in the previous segment, our open order book is very strong. It has grown substantially. And that gives us very strong visibility into what this coming year and the coming years will look like. And there's a lot of momentum also on our funnel and pipeline. So both execution based on open order book, as well as execution that will happen based on in-year orders. I think we are really excited and bullish for the year. And it started off well too in Q1. As you said, there continues to be growth on the revenue side, even on EBITDA year on year. There are good wins that we've had across automotive, enterprise, and government. And on IoT, as you said, it's a growth engine. We had a quarter where a lot of hardware, revenue grew, which means that the SaaS revenue will kind of kick in post that, and that will further kind of enhance the margins as we grow, as we go in the time to come. So all in all, looking really good. Teams are fully kind of geared up to make some of the things from last year, which kind of got delayed or time shifted. Otherwise, last year also would have been a good growth year, like the way it's been happening for the last 4 5 years. But we are pretty confident that we'll kind of get back to the way that we've been growing while keeping the margins strong.
So, Rohan, when I'm analyzing your numbers, you did 100 crore of top line in Q1 FY25. You did 122 crore Q1 FY26. So, your Q1 versus Q1, the last 2 years, have done fairly well. Is that why you've done just 15% this particular quarter? And therefore, Q2 onwards, should you see a significant and meaningful uptick in revenue? Because that's where the revenue compression has come from, Q2, Q3.
Yeah, see, Q1 is typically kind of, especially on government, it's a slow quarter. It's the first quarter of the year, and revenue does build up more and more in Q3 and especially Q4. You can see that trend in the last few years, and definitely some of the things that we saw get delayed last year. Not everything. Some of it that we saw get time shifted last year will start kicking in. Some part in Q2 as well as in Q3. Anyways, the open order book is also larger, and then again going into FY28 beginning, some of the other things that had gotten time shifted shall come back online. So all in all, really good kind of visibility that we have. But yeah, we got to keep executing well and keep course correcting wherever required to keep kind of performing.
Rohan, I'd be curious to know, and I know you've answered this multiple times, but for the viewer who's looking at the company now afresh, why does revenue get time shifted? Give us a sense. What's the risk of this happening even in the current year or the next year? Because your FY28 earlier your FY28 guidance on top line was 1,000 crore. What happens to that? Give us a perspective and just explain this time shifting of contracts.
Yeah. Yeah. So, I mean, last year there was a couple of government contracts and one automotive OEM contract that got time shifted. What that basically means is with the government, we kind of had won the order, but by the time that budgets came in and, from the government to actually start executing and paying those for those contracts, that got time shifted. This happens sometimes in government. It's not kind of out of the normal. But kind of course correction for us is to basically have a larger portfolio, a larger funnel, so that if something kind of gets time shifted, others can make up for it. And then in general, we are highly diversified across the number of customers. So just because of something happening, it didn't actually have a serious negative impact on the company. And in automotive, also one of the OEMs that we had from where a lot of growth was and is going to happen. In their case, due to their own competitive pressures, the technology, not just ours, but in general, the technology that they were looking to put in their lower end vehicles, which are larger volume, that they reduced for the time being. That, as we understand, will come back, starting later half of this year or beginning next year. So they remain a client. There are volumes and significant amount of revenue we get from them, but the growth that we were expecting last year, that didn't happen, and these contributed to last year's kind of flat growth. But the same things could happen, but we are more diversified now with a larger open order book, with a lot more wins, and which should kind of mitigate those risks, and in fact actually lead to kind of more growth.
Understood. So 1,000 crore revenue FY28 or maybe midway FY29 or full year FY29? What's the internal goal now looking like?
Yeah, I mean, it's time shifted, but not by multiple years. So I mean, we are still working towards it. We are working hard. We would love to kind of show through our quarterly performance so that people can kind of see how we're doing, and then ultimately for the year. So we're sitting in FY27. There's FY28 to come, and then FY29 after that. So I'll not give like specific guidance on the milestone, but in general, I can say that there's a lot of market opportunity for us. We're multi-product, as you explained nicely, across maps and IoT and further products within that. And we're multi-industry. with multiple use cases per customer. So it's just a function of us unlocking more and more use cases for our customers and licensing or generating subscription revenues from those. So we are bullish. We are focused on growing the business. It is going to happen. It's just a question of like when and not if. And we'd of course like the when to happen sooner.
Got it. Rohan, I'm just going to quickly have my producer and director pull out the estimates, which consensus analyst estimates have been. And basically, they are penciling in FY29 revenue of roughly 900 crore. Would you comfortably say that you'll exceed that? I mean, that seems to be something that you seems to be indicating. So I'm trying to get a sense as to whether you would say that.
I wouldn't be able to comment specifically on the estimates or the guidance, but like I said, you see the track record last 4-5 years cumulatively from a CAGR point of view. You see the way the open order book is growing. You've kind of shown book to bill, and I think that visibility should give comfort to investors. And with the initiatives that we are taking now, I think there will be further acceleration and growth. Yeah, that's what I can say right now. Sorry, I can give a like very specific.
No, I mean, I'm sorry if I put you on a spot, but I'm just trying, right? So now, Rohan, give me a sense. IoT versus Maps, right? Maps is the higher margin business. IoT is a slightly lower margin business, but faster growing business. How do margins evolve? One, on a blended level, you've done 40% plus this quarter itself. Can that sustain, given that growth is going to come back? And second is, how do IoT margins evolve? Because that will likely drive margins even higher. I'm trying to get a sense as to whether I'm thinking right and if you have any input on this.
Yeah, absolutely. There's a lot of growth possible for us in both Maps and IoT. We're unlocking more growth opportunities for us in Maps, especially on the public sector. And besides the automotive and enterprise, where anyways we've had a very strong franchise when it comes to Maps, and there are more things coming down the line for both automotive and enterprise from a Maps business point of view. IoT, yes, you've seen the margins consistently increase kind of year on year from a low margin base in the beginning as we were building out in the business. But with more and more SaaS revenue, the margins are constantly going up. And we continue to see expansion in the margin in the time to come on IoT. So in that sense, we've always given the guidance that will be 35% plus. We maintain that. Our track record is higher than that, higher than that 35% kind of margin guidance. So we'll see where we end up. See, EBITDA is also a function a little bit of what investments we want to make on R&D and product. And so last year, specifically, we did a lot of investments in our products, both Maps and IoT. We did HD Maps, we did investments in navigation, in our GIS platforms, as well as in our IoT platforms. But that kind of gives us this strength for staying at the cutting edge of tech. We did a lot of investments also in the AI native space, which will start kind of playing out this year as well as in the years to come. So it's always a tussle between kind of what margin you want this year versus what kind of growth and what margins you want in the future years. But fundamentally, this is a really strong business with 40% plus typical EBITDA margins. So we have that ability to kind of invest without margins compressing too much and also then driving growth in the time to come.
Right. Rohan, quick follow-up. Do you expense a lot of the investments you're making, or does it sit in the fixed asset base of MapMyIndia?
Yeah, a lot of investments that we make, do get expensed. Of course, some get capitalized, both on the tangible and intangible side. Tangible side because the hardware that we give out as a service, it sits as a fixed asset and then it depreciates over time. And then intangible is obviously a lot of the software and map products that we make, but a lot of investments that we're making in capacity and like capabilities, we also do expense.
Right. Rohan, last quick question. The worry is working capital. Does that unwind FY27?
Yeah, I mean, see, we have a very strong cash base. As you said, it's about, I think, 745 crores versus 685 crores last year. End of last year, in the last 3 months, it grew to 745 crores. And that's the bulk that we have that allows us to kind of take up more and more kind of projects. But of course, we are still careful and calibrated on what kind of projects we pick, and what the payability of that is, what the working capital on that will look like. But from a balance sheet point of view, we're debt free, growing cash balance. We're able to support, both IoT as well as government. These are the typical areas where you need to be able to withstand a payment schedule, which will take time versus the investments or the expenses that you incur. And so we are well suited to be able to deal with that, and that gives us the ability to play in projects and to deliver things which other companies with not as strong a balance sheet or much smaller cash balances and not as healthy margins cannot do. So that gives our customers the comfort to work with us as a solid kind of company.
All right, Ron, pleasure speaking. Thank you so much for coming in and breaking this down for us.
Thank you, Harsh. Really appreciate it.
Thank you, Ron. Okay, completely timed out on this edition of All About Your Company. Thanks so much for tuning in, viewers.